Welcome to the November 2023 installment of our investment update. As always, this is provided to give you a bit of insight into what's going on and, more importantly, where we think things are going to go with regards to the economy and the markets. So this update, we've got some stuff planned for you. Certainly, the markets have responded well over the last month. They hit a low last week or so of October and have come back quite nicely. This is pretty consistent with the end game scenario that we had spoken about, or we have spoken about since last April, that a recession is coming, but there's still some upside to go. Notably, recessions are often unexpected and underreported. And the reasoning there is that central banks have to remain optimistic. As soon as they were to turn negative, it would certainly have the completely opposite effect of everything that they're trying to do, which is to maintain some stability in the markets. And then lastly, we'll get to interest rates, unemployment, and inflation, how they're all linked. And right now, everything is indicating that a recession is going to be the result of the current tightening round. As always, we don't claim to all of the ideas we had. We've got a series of investment ideas and research providers that we pay to use, and then we retest them and look for corroboration through independent sources for you to read, a regulatory disclosure in your own time. So a quick recap from last month. Last month we talked about our pre-recession indicator. We will update that again today, but we'll do it in the context of the other topics we have. We talked about bonds and interest rates and how bonds react to both rising and falling rates. Bonds have had a terrible 22 months, really since the beginning of 2022. And that is because interest rates have been rising, and the Federal Reserve, in fact, all central banks, have been aggressively tightening to beat inflation. We also talked about how consumer spending is set to decline, and we think that is going to continue. And we have seen numbers that corroborate that as well come across, and we'll talk about a couple of those. So the changes since last update, like I said, markets are up about 7%, the equity market, and bonds up about 3 or 4. The U.S. government bond in particular is referenced here, up 3. Unemployment was higher in November. It surprised to the upside. The expectation was 3.8. It was 3.9. And that's up from 3.7, I believe, the month prior. And inflation was flat, and that surprised to the downside. So lower inflation and higher unemployment, that's sort of temporary good news. And again, this is sort of moving through that Goldilocks phase that we thought we would experience. And that's good news temporary for equities. So once rates come down, that sort of is positive news for pricing models of equities. But if unemployment continues to rise and if inflation continues to fall, particularly at the rate that it did this past month, that would indicate that the economy is slowing down and, in fact, in some trouble. So it's important to note that unemployment and CPI, so that's consumer price indicator, which is inflation, they are pretty related. And if you're looking at the chart and you're watching, you can see that spikes in unemployment and spikes in inflation or CPI tend to be timed together. However, unemployment tends to lead CPI, meaning unemployment rises first and then inflation falls. And so you can see as we come along here, you've got these orange arrows where unemployment is rising. And the result of unemployment rising is that people spend less. And if people spend less, then inflation is likely going to fall because you've got a reduction in demand. Again, all things being equal, you've got a reduction in demand. So you can also have an increase in supply, which decreases inflation. But in the context of employment, which is, the consumer and the consumer's ability to generate income, which is then used to buy things, the decrease in demand is notably, if you will, one of the most important drivers of a falling inflation. This time is a bit different, though. So if you look at the far right side of that, CPI actually dropped first. And that is not surprising, CPI again, inflation, because of how aggressively things were being tightened. And it's also not surprising because the dynamic of the pandemic meant that you had this leftover glut, if you will, of employment demand. At which point it had a first peak in March of 2020. It peaked again in the fall of 2022. And so even though rates started to rise, it didn't do the job. And of course, they continued to raise rates, which they needed to do. After a plateau in the first half, let's call it, of 2023, rates finally began to fall in a sustained fashion mid-2023. So this is about 6 months ago. So May, June, July were consistent down months. And what that leads us to conclude is that the initial fall, meaning from when they started to raise rates in March of 2022 until earlier this year, was really attributable to consumer psychology rather than what we really want, which is a tightening of interest rates, because that fall is now sustained. And so really over the last 6 months, May until now, that is when rates have fallen, inflation has fallen as a result of tighter monetary policy. And so we go over to monetary policy. And so this chart here is the hikes that the Federal Reserve put in place from early 2022 through until it paused in July. Although it looks like money has been tight since December of 2022, we have to remember that there's lags in monetary policy. And so whether those lags are 6 months, 12 months, or 18 months, they are helpful, or those lags, are helpful to demonstrate why things are only now, or really only the last 5 months, starting to flow through into the system. And so what we can see here is we're going to build where those hikes are. So from where we're at now through to the future, what we can see is if we assume a 6-month delay, there's still one more hike that has not yet been experienced by the system, by the economy, if you will. If we assume a 12-month delay, then you've got about 4 more hikes that still need to be experienced. And if you assume an 18-month delay, then you have got 6 more hikes to go. And so given where that inflation plateau through the beginning of this year and then fall, what we can assume is monetary policy really was only tight in May, June, or July. And therefore, somewhere on this chart between the 6-month lag and the 12-month lag is the logical location, if you will, of where we expect monetary policy to be tight. Meaning there's still a couple of hikes that still need to get into the system. So this is our recession scorecard, and I've taken a picture, if you will, of last month's, which gives us our prediction of where things are at. And I've got employment circled because that is the last, quote unquote, the last shoe to drop on this chart, meaning unemployment hasn't gone up by a full 50%. I did indicate it had before, but it's not quite there yet. And so if we get a rise in unemployment on December 8th, which is coming up in about 2 weeks, what we're going to see is a change in that number. And that number changes to 3. And then what you can see is these estimates come forward quite significantly. And as a result of coming forward, what we've got is this model now predicts the recession starting mid-February 2024. And then, of course, as a result, that gives us, again, an estimate that the market has already peaked. And in fact, we may be in the beginning of that sort of pre-recessionary move. When I say already peaked, the markets really would have peaked in July of this year, which I think is the height that we experienced this year, or maybe August. And so September, again, this is just an estimate and more illustrative than anything else of where we're at. So effectively, if we do get a December a report on unemployment and it goes up again by even 0.1%, that would give reason for all of, if you will, the indicators we have to be flashing recessionary signals, and reason for that timing to move up by about 5 weeks. So the other one that I think is worth noting, and we had one of these charts last month, and I wanted to walk through them, is what do the experts say? So I mentioned as we led in that central bankers are going to be positive about the economy and about the job that they're doing, almost no matter what. Because if they are not, then people are going to panic before they need to. Unfortunately, the flip side of this is people tend to be greedy on the way into something. And so, for example, where we're at right now is the markets are climbing the proverbial wall of worry as we get bad news, but they continue to rise. I think there's a bit of greed, if you will, in that pattern. And so one of the things you can look at is this is a chart from the Wall Street Journal indicating that the number of mentions of a soft landing spike considerably right before recessions. And there was one obviously in 95. Just if anybody's watching, in 95, there was actually a non-North American financial crisis. It affected mostly the Asian markets, but interestingly enough, before all of the recessions that we've experienced over the last 25 or 30 years, we have had the predictions, if you will, of a soft landing, and then they don't occur. And again, you can also look at, this is what I showed us last time, which is a series of different Google hits that you can look at on the news. If you see all of these in 2007 predicting that we would hit a soft landing, and it's not just the Wall Street Journal, it's not just the New York Times, but this is, the IMF and the Federal Reserve themselves declaring that there would not be, or there would be a soft landing, and the economy would be okay. That is before the worst recession we've experienced, notwithstanding, of course, the Depression in the 30s. So where does that leave us going forward? We still are advising being flexible with this, what we'll call shorter term upside. Current rally could continue for a while. If you were investing on your own, buying into this would be a little bit, if you had a very, very tactical time horizon, it would be the thing to do. However, what it really does is it gives an opportunity for you to reduce risk and reposition a portfolio. From there, you build bonds from either existing cash or equity. You want to focus on government and high quality and building longer duration. And that means you get a better result when rates fall back down again once a recession hits. And again, bonds anticipate rate cycles. And so the fall in bond yields or the rise in bonds this month is because the bond market is starting to anticipate, first of all, a plateau in bond rates, but then potentially an earlier cut to rates or a pivot in Federal Reserve and central bank policy faster than we think. As a result of all this, or certainly where we're at, is expect downside in equity markets over the next 12 months. The most likely surprise I think we see over the next little bit is that interest rates are cut faster than anticipated. The fact that there still is some interest rate cuts that are moving through the cycle, that's significant. The fact that the Federal Reserve has been on pause since July and has not raised rates meaningfully since then. The rhetoric is still what is called hawkish or cautionary, that they may raise rates more. But I think what we will see over the next 6 to 8 weeks through into early January is a change in the language, and then starting to telegraph that rate cuts may be coming sooner than we think. Those surprises seem like good news now, but what likely will happen if a cut occurs is that the economy has turned in such a way that they need to cut those rates in order to save the economy from a downward trajectory. So those are our recommendations and our thoughts. Any questions or comments, please contact me, and I'd be happy to provide further commentary or give some more light to some of these thoughts that we have. Thanks very much for listening, and we will see you again next month.